I'm here today with Paul Slider. Paul, I'm really excited to see you and interview you, and I appreciate your being available for today's interview.
Well, thanks for having me. I appreciate it.
Let's talk about Calmwater. What does Calmwater do? What kinds of loans does Calmwater make?
We provide, our clients, developers, owners with timing and certainty of execution. So whereas a lot of real estate lenders generally take anywhere from, 4 to 6 weeks to close a transaction. And then we do a lot of work on the front side. So we provide our clients with certainty of execution. So we're not the type of lender that's just going to, issue an app or a term sheet and figure it out in underwriting or due diligence. We do a lot of work on the front side. That way, a high percentage of our, deals, term sheets close exactly as they were apped in the term sheet. And for the ones that don't, something popped up during diligence that neither the client saw or we saw. And then we generally put our heads together and figure it out. But timing and certainty of execution is kind of how Calmwater sets itself apart in a crowded field.
What are the interest rates that borrowers pay in this market, and what kind of fees do they pay today in general?
I mean, there's been a lot of yield compression across, all four corners of the real estate landscape. But for us, I mean, we're generally, L plus 550 up to L plus 8, depending on, our view of the risk, the risk profile of the deal. And it's generally one in and one out in terms of, origination fee, exit fee. And then if there's any extensions, you generally get, 50 to 100 bips for extensions as well.
Okay, so let's convert that for the lay person. L is LIBOR, which is currently under 50 basis points, maybe under 30.
I believe it's 15 to 20. I haven't checked. I apologize. I just got back from vacation.
Okay.
So I'm not as up to speed as I should be.
So L plus 550 would be a little under 6%, and L plus 800 would be eight and change as an interest rate, right?
Yeah, we generally have floors anywhere from 25 to 100 basis point floors. So even with LIBOR kind of muddling around where it is in this low interest rate environment, we have floors from 25 to 100 basis points. So you could be 550 would probably be 575 to 6 on the low end, and L plus 8 could be all the way up to 9% if there's a 1% floor.
Got it. How are your investors getting their target returns? Are you using structural leverage as part of your model? For example, if you make a loan at 6% rate, your investors want to, probably want a return that's north of that. So how do you get them the return that they need? Do you use some structural leverage or not in your business model?
We do use some structural leverage, but we don't rely on it when we're pricing on the front side of a transaction. I mean, we have a target return, and it's just a target return, by no means, guaranteed. There's always a risk of loss. However, we generally shoot for an unlevered return of 8 to 10%.
So maybe of the total capitalization, levered capitalization of your vehicles is leveraged less than 25%, typically less than 20%, or somewhere in that range.
It's below 50%. I think historically it's been, below 50. I would say somewhere in 30 to 40%. Whereas a lot of other participants in the market or in the industry, you can read up on them. They're 2, sometimes 3, even 4 times levered on their book, and that's just not. We're focused on the downside. We're more conservative in that, just given that these are transitional assets.
Talk about your loan to cost and loan to value. How do you decide how much to lend on a given asset?
I mean, obviously, for certain asset classes that are more in vogue, we're willing to take a little bit more risk in terms of loan to cost, maybe low to mid, sometimes high 70s for an LTC basis. LTV, we generally cap out around 75%. Our target is 65 to 70. Obviously, given the current competitive landscape, for us to win some deals, we have to be accepting going north of 70. But those assets that we're willing to tolerate higher than 70 but lower than 75% LTV are generally those that have a more sound risk profile. I think a good example of that is multifamily or industrial, that you can look at the growth prospects of where they've been over the last 2 to 3 years, what's going on in the market today, as well as where the industry is heading, where the economy is heading over the next 3 to 5 years. Namely, this country has a significant shortage of housing supply, and with our shift gradually from in-person retail to online, you can see industrial being having a significant amount of staying power.
What do you see 3 to 5 years from now? Do you see non-bank lending continuing to grow? Do you see what do you see in the competitive trends? Talk about 3 to 5 years from now.
I can see a lot of equity shops, kind of realizing that debt isn't, their bread and butter. It's not as easy as it looks. And pivoting back to placing equity investments as opposed to debt. So maybe the proliferation of non-bank lenders will start to, ease a little bit. The platforms that have a demonstrated track record and expertise in being non-bank lenders will continue to capture more market share, in my opinion.
What about the risk for investors? What would be the number one thing, or maybe one or two things that could cause a loss of principal in your strategy, given that it's a more defensive strategy and you're the lender, not the equity? But what do you see as the scenario in which there could actually be a loss of principal with the type of strategy that you're pursuing?
Well, I think the things that we really drill into to kind of, gain high conviction that we're not going to have loss of principal are the sponsor's ability to execute its business plan. We really dig into sponsor track record. How many times they've done this? Where have they done this? Do they have experience with this business plan in this market with this size of project? And then do they also, are their incentives properly aligned? Do they have a lot of their own skin in the game, so to speak? Do they have their own cash equity in the game? Are they well capitalized? If the business plan gets delayed or there's a wrinkle, it goes sideways. Not only do they have the track record and the ability to kind of pivot, but they also have the balance sheet and liquidity to keep the project going if it's delayed or if there's a cost overrun. So that's kind of the first thing that we really drill into. And second, we're the debt. We're always looking at what the downside is. And we go into each investment with, high conviction that there's a significant amount of basis cushion between what we think that if we had to step in to the borrower's shoes and own the asset and liquidate it, we want to make sure there's a significant cushion between what we think we can liquidate it for and what our last dollar loan basis is at.
How does an investor participate in everything you're talking about?
Well, the way we're capitalized is, we have 25 to 30 institutional investors, which is pension funds, university endowments, and high net worth individuals that can provide us investments. It's generally 5 million plus. And they would, when we fundraise, we go out and look for, those investors to hit it. We're generally looking to raise a certain amount of capital, 500 to 600 million, when we do fundraise. And you can participate in that by investing in the fund, $5 million. It's generally a 3 to 5 year investment. And then from there, we generally try to provide, and our target returns on an unlevered basis, and they're just targets, they're definitely not guaranteed. There is always a risk of loss of principal, but our target return is, 8 to 10%. And historically, we've done higher than that.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.